to this edition of the Money Mile. Joining me today is Radhika Gupta, one of the most dynamic leaders of the Indian mutual fund industry. She is the CEO at Edelweiss Asset Management. Thanks, Radhika. Great talking to you after many, many years. My first question to you is that, we've seen an unprecedented set of events when it comes to a certain category of debt mutual funds in the last few days. And that has, of course, unnerved investors. While when it comes to equity, we talk a lot about risk. But what is the risk involved when you invest in a debt mutual fund?
Hi Vivek, good talking to you after a long time, and I think you opened with a very relevant question and I'll take the liberty to be a little frank here. I think over the last week or two, there have been a lot of investor queries, advisor queries about debt mutual fund, and my fundamental belief is that mutual funds in India will not win until we get debt mutual funds right for investors, because we keep talking about asset allocation, and debt is such an important part of our asset allocation. And as Indians, we are fundamentally conservative investors. So if we don't get debt right, we are not going to get investing right. So you can't ignore debt mutual funds. And, a lot of people have been asking me, should I still be spending time on this category? The answer is absolutely yes. Don't let a few incidences color that. I think one of the challenges, as you made the comparison to equity, is that Indian investors have not either been explained or taken the time or whatever it is to understand that debt mutual funds actually have two kinds of risks. We come from an FD background which says effectively, itne time mein itna milega, I'm going to get this much return in this many years. But you have to remember that debt mutual funds carry risk. They carry less risk, and they carry two very specific types of risk. And I've also seen this being confused a lot in the last few weeks and months and years, actually. They carry duration risk, which is the risk associated with interest rates moving up and down. And broadly, if you hold a longer tenure paper, you're going to carry more duration risk. The second risk they carry is credit risk. This is the risk, very simply, if you lend to a lower quality borrower whose repayment chances are maybe less than a good quality borrower, and if he doesn't pay back or if he delays paying back, then there is some kind of credit risk. And what you've seen over the last few weeks is a manifestation of credit risk. I have two simple tips for investors who are investing in debt. You can solve for both these risks. One, avoid credit risk, because I think when you're investing in debt, don't reach for that 1% or 0.5% extra. If you want to take that kind of risk, now go take equity risk. Don't do that in debt. So avoid credit risk by looking at funds that don't have significant amount of credit risk, that hold highly rated borrowers, etc. And the second, duration risk. If you're investing 3-month money, invest it in a fund that holds 3-month assets. Then you won't have duration risk. So these are two very simple ways, I think, to solve debt mutual funds. But my overarching message is debt mutual funds are right. You have to study them better and ask more questions.
Always a pleasure talking to you. Thank you very much, Radhika, for joining me here and educating our viewers on these very, very important issues. Thank you.
Thank you, Vivek.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.